All right, everybody, ladies and gentlemen, hello and welcome to Nadex. My name is Philip, and I will be once again your presenter for today's webinar, Live Technical Analysis, the Market Movers for today, February 6th of February. Just a second. Yeah, we're looking good. If you have any questions, please put those questions in that small questions box. Right now, I would appreciate a very short yes or why in that box to just let me know that both the screencast and the audio are working properly and that you guys can hear me well. Perfect. Thank you very much, everybody. Really appreciate it. Yeah, as I've said, ask questions. We want to learn something together. I think asking questions is a vital part of that experience. And so I do my very best over the next half hour to try to answer your questions as we move through the webinar. Here you can already see our first risk disclaimers. Please take a moment of your time to read through it carefully and make sure that you're okay with it. Essentially, this says that trading, of course, involves risk, and you should understand those risks and the risk associated with the instruments you're using before you are getting active in the market. As neither Trade with Position nor myself are investment advisors, nothing that we say should therefore be considered to be actual investment advice. Especially true for the live part of today's webinar. We will be looking at the markets together. I will be analyzing those markets together with you. But even if I say I see a shorting opportunity there, I see a long trading opportunity there, it's always just that, my opinion, and it's always there just for educational purpose. You must own that trade. You must understand why you personally want to take that position, and therefore it's always your decision. We can just try here to help you with your trading education. So please make sure you're okay with this before continuing with the webinar. And we have another risk warning from Nadex coming up. Nadex risk disclaimer: trading on Nadex involves financial risk and may not be appropriate for all investors. The information presented here is for information and educational purposes only and should not be considered an offer or solicitation to buy or sell any financial instrument on Nadex or elsewhere. Any trading decisions that you make are solely your responsibility. Past performance is not necessarily indicative of future results. Nadex contracts are based on underlying asset classes, including Forex, stock index futures, commodity futures, cryptocurrencies, and economic events. Trading can be volatile, and investors risk losing their investment on any given transaction. However, the design of Nadex contracts ensures investors cannot lose more than the cost to enter the transaction. Nadex is subject to US regulatory oversight by the CFTC. That being said, let's have a look at today's agenda. You know that agenda. If you have visited our other Market Movers webinar series, we want to understand how to trade those markets. And this always comes from having your own trading strategy. I need to have a plan. I need to have something, I need to have identified some kind of pattern that I like to trade, which if I backtest this pattern, appears to give me an edge when it comes to my trading. And an edge is something where over a large sample set of trades, I should probably be able to win those setups more often than I will lose them. And there will be losing trades. There's no way to sugarcoat that. Having losing trades is just part of trading. Trading is always about statistics and trying to have more potentially profitable trades on your hands than losing trades. And those potentially profitable trades also should be larger than the losses that you will have to occur when you're placing those trades in the market. The only way to be potentially successful in the long run is having your trading strategy, because this makes your trades comparable. This law of big numbers suddenly can start to work in your favor. If you just act from a gut feeling and pay attention to different indicators all the time and just jump around and switch your trading setups all the time, there is no consistency. This law of big numbers cannot apply for that. You need to have a strategy. And here in this webinar, I want to show you the kind of strategy that I'm using when I'm trading the markets, and show you how I analyze those markets and what I'm looking for. And yeah, that being said, let's just jump into the markets right away. And I'll grab my charts here for that. And you can already see here on that chart, big move in the market. What can we see here? It's the S&P 500, it's the E-mini futures, it's the underlying market for the S&P 500. And obviously, that market was in a beautiful uptrend all the time. and we started to get a bearish candle setting up, and then price started to pretty much fall apart. Now we're looking here at a daily chart. This means that one candle represents one day. And you can see that those candles are rather small, and yes, they become a little bit larger, but once market becomes indecisive, they become smaller again. And guess what? Once the market starts to fall, those candles tend to become really large. This large, the size of the candle, this is something also related to the volatility of the move. Here you can see how price actually moved. This is so-called historical volatility. Price movement and price directly observed in the market. There's another kind of volatility being used when it comes to pricing options, and that's implied volatility. What movement are market participants expecting over the next few days and hours and weeks? And this is implied volatility, and this is also reflected in the pricing of those options. Now, before we come to the pricing of those options, let's have a look here at what the market has been doing. Beautiful uptrend, higher highs and higher lows, and then price started to pull back. This is something that can be expected because you can see here price is pushing higher, it's pulling back. Where is it pulling back to? It's pulling back towards our moving average buy zone, the 10 and 20 period moving average. And as long as we have this fanning pattern, which is pretty much what we had at least here starting back in September 2017, this market has been in a steady uptrend, nothing wrong, just continuous price movements. But now here's the big disruptor. You can see those large candles, and price didn't stop here in the moving average buy zone. It dropped below that moving average buy zone. It dropped to the 50 period moving average. It found some, when you watched the session yesterday, price found some kind of support there for a while. It looked like the market moved to the downside, got rejected here at the 50 level, but in the end, price really fell through, and there's no way to really sugarcoat it here at that stage. Here on the daily chart, this would have still been some kind of rather hefty correction, some rather strong retracement, but now with price falling through the 50, that uptrend on the daily chart is definitely gone for good. What is the last relevant swing point low as a reference point? I would pick this one here, because now we can see that with this swing point low, clearly price made a new lower low, and guess what? Today price even dropped to test the 200 period moving average. Currently, it looks like this move to the downside is rejected. What's the general structure of today's candle? That candle pretty much is indecisive. What makes an indecisive candle? Well, the upper shadow and the lower shadow are somewhat the same size. Yes, the lower shadow is longer, which makes this candle more bullish. The body is also a little bit bullish, but the body is rather small. It's sitting just in the middle, round about the middle of that candle. And overall, indecisive candle, huge candle, nothing to trade off here from the daily chart. If you have a look at those candles here, and I'll try to make it a little bit larger here, you can see pretty much the same structure that we had here on today's candle, at least up until now. Body, rather small body, sitting in the middle of the range, indecisive candles. It was not clear what was going to happen here. At that point in time, there was still a decent chance the price might actually start to push higher and make way for the next higher high. Didn't happen. Now you might say, wait a minute, you're performing this analysis here, you have to know what happens next. Guess what? I don't know what happens next. Nobody knows, even if they tell you on CNBC or any kind of other screaming television show. Nobody has a crystal ball. The only thing that we can do as traders is try to stack the odds in our favor. And this means I am able to identify certain behaviors in the market, which I think give me an edge. Remember that having potentially more profitable trades in our hands than losing trades, but there will be losing trades. There wasn't a setup here. Those candles were a little bit too large, and they weren't really bullish enough to warrant a kind of long setup here. If we would have traded that here as a long setup, my entry could have been, let me grab my trend line here for that, a horizontal line. A potential entry might have been just above the high here. Guess what? even if I would have traded that setup, which would have been a bad setup in my book, the trade wouldn't have triggered. First thing. Next thing, even if I had screwed up and would have jumped the gun and tried to really force my entry into the market, even though the trade hasn't triggered yet, where would have my stop loss been? My stop loss would have been just below the low of that potential candle here. Guess what? Even if I would have jumped the gun, would have opened that trade, I would have been stopped out immediately here right away. And I would have been out of the market. All this drop here to the downside, gone for good, no problem for me, because I would have been stopped out. Proper risk management is absolutely paramount. And guess what? Those Nadex contracts make incredibly easy to apply proper risk management, because you know upfront how much money you're going to risk when you open that position. Definitely no setups there. I just wanted to highlight the principles. Even if I misread the chart, and even if I had placed a bad trade, why this actually wouldn't have done much harm. Yes, I would have lost money, but I would have lost little money if I adhered to my risk management plan, and everything would have been nice so far. Let's have a look at this picture here. You can see that price tested this level here back in the day before price actually started to push higher. Those lines, those horizontal lines, 2 lines of support and resistance, they stay on my chart, because once resistance is broken, it tends to become support. Didn't happen here. We might be able to see some kind of support action going on here on lower time frames, but once we are back below this level, it turns once again into resistance. And this means price will probably react to this price level of around about 2,700 once price starts to reapproach this level from below. Just a few seconds, guys. All right, sorry about that. Still got a nasty cold, and every time I cough, I try to hit the mute button as fast as possible. So back again, we're looking still at the daily chart. Let's drop to a 4-hour chart here. And no support here on the 4-hour chart. Price actually really fell through. I think that this level still will become interesting over the next few days, hours. Now we are looking at a 4-hour chart. One candle is 4 hours. And this level, I think, becomes even more interesting once I start to apply my fib retracements from this swing point high to that swing point low here. You can see that this level sits right in my sweet spot. That sweet spot for fib retracements is between the 50% and 61.8% retracement price, and that level is right in the middle. So this gives some more weight, some more importance to that level. And if I apply the next fib retracement from the more recent, from the older swing point high to the same swing point low, you can see that from this point here, that level pretty much also clusters with a 50% retracement. So I think there's still a decent chance that we might get a pullback here to this 2,700 level in the S&P 500. And see again, on the 4-hour chart, this is now a clear downtrend. I can see lower lows and lower highs. Yes, those candles are larger. I think if price pulls back to this level here, currently this level is also sitting here in my moving average sell zone. The 10 and 20 period moving average tell me that this is the sell zone. The 50, the 200 hasn't fallen yet into place, but that's just a matter of a few more bars. And my setup that I am stalking here right now is I want to see a small bearish candle setting up here just below this level. That would be a very sweet setup here for me, something that I'm stalking. Again, that's just me. That's the type of trade that I'm looking for. You want to understand why I'm looking for that trade, for that setup, and you have to own it in the end. So it's not a recommendation. This is something that I'm monitoring here currently. And because I feel that if price pulls back to this level, giving me a small bearish candle, I might find a decent reward to risk ratio setup on that trade. The question is then, how could this be traded using Nadex options? And I just quickly want to jump over here to the Nadex platform and, for example, looking here at some kind of spreads. and we're looking here at the daily spread. Just a second. Yes, we're looking at the daily spread with about 4 more hours left. Would I trade this here in this setup? No, price isn't there. Yeah, right now, price is still about maybe to pull back a little bit further. What kind of spread would I be looking for here? Remember, that level is sitting at 2,700. I would be looking for a level which gives me a floor of around about 2,700. Remember, every time I want to trade a spread to the short, I want to short that market, I want to enter that spread as close to the ceiling level as possible, because then that whole range of the spread between floor and ceiling is potentially working for me. Price can drop all the way, but probably price can't go higher than that because I entered at the ceiling level. So I'm looking for something here. Once that setup starts to show itself, I want to see a spread which is trading here with the ceiling at 2,700. Now, price is currently trading where? Price is currently trading at 2,648. And guys, this is the price of the future. The way those contracts are settled is a little bit different. Some kind of averaging algorithm is taking place. You can read everything, how the price, the fixing of this underlying market for those Nadex contracts is calculated and determined. All this is well documented on the Nadex website. So please have a look around there. I always use just the future here as a proxy for the underlying. So 2,650 trading right now. So the idea is if I enter here any of those markets, I should be, let's take that 2,640. We are trading currently above the ceiling. So if I want to sell this market, my risk should be pretty small. However, my risk is still $117. Why is that the case? Usually, I should see a number here like maybe $20 with the same potential maximum profit. Why is this number so large here compared to my maximum profit? Very simple. I mentioned before that volatility goes into the pricing of those options. And guess what? Those candles have become really large. People currently anticipate the market is moving a lot. And because they think the market is moving a lot and might be also doing so in the future, they want more money if they sell you that option, if they sell you that spread. And that's implied volatility. So big fear in the market of huge swings ahead, or we already see that those swings have occurred in the past. Volatility is high, those options become more expensive. Always keep that in mind, that even with those short-term Nadex contracts, obviously volatility plays a major role when it comes to pricing those options. So S&P 500, that's the setup here that I'm currently stalking. The other markets, pretty much the Nasdaq, the Dow Jones, pretty much the same big picture, telling currently pretty much the same story. I want to have a quick look here at the, sorry guys, yeah, I want to have a quick look here at the Japanese yen. No, sorry guys, that's the Nikkei. I want to have a quick look here at the Nikkei. Nikkei also has dropped below this level. We know this level here also from previous price action. You see price has tried to break above this level here several times. Finally, it managed to break above, came back to test this level, and this level currently sitting here. Looking now once again at the 4-hour chart, decent probability that we might see some kind of pullback towards this level. And if we start to actually apply our fib retracements here, we start to see that this level here also tends to cluster with a 78.6% retracement of the recent move and the 61.8 of the previous one. So also, if you're interested in this market here, in the Nikkei, then you have a potential cluster setting up here as well. By the way, that's a very kind of aggressive trade, because we will have to pull back way beyond the sell zone here to get this cluster. If you want to play it a little bit more on the safe side, there's no sure thing when it comes to trading, and we're losing them the potential role and support of this level here. Please note also the cluster of the 38.2% retracement with the 50% retracement here around about this 22,270 level, which is sitting right in the sell zone. So that's another potential target for a pullback. All right, let me quickly check the watch, but so far we are good. Guys, are there any questions so far? If so, please let me know. And if that's not the case, then we can also have a look at the Germany 30. The Germany 30 is also pretty much painting that same story as before. The big benefit, if you want to trade the underlying markets for the US markets, you see the German stock index, it's not really that continuous trading action. You have gaps in between here. Shouldn't be an issue when you're trading the Nadex contracts with those life cycles and expiries that you have available for your trading, but that's something to note. If we zoom out here, a rather interesting area. Sorry guys, this chart here pretty much is completely off from the price levels that I usually have on my chart. And this doesn't make any sense here to me. Guys, sorry, let's forget about the Germany 30 here. Those prices are definitely off. In the DAX, there's a level or clear-cut levels between 10,000 and 10,800 points, and those price levels are really off here. Sorry, that's bad data, and doesn't make sense to focus on those markets here. Let's have a look at US oil, because people always tend to say, okay, the equity markets are really rather dangerous, or might be considered dangerous territory right now. So let's move rather to some kind of safe havens or somewhat uncorrelated markets. And one of the natural fits for that usually are commodities. So let's have a look at oil, gold, and silver, just to give us an idea what those markets might be doing. Ward has been asking, and thank you very much for that question, Ward, whether those are EMAs, exponential moving averages, or simple moving averages, and actually it doesn't matter. I'm using exponential moving averages right now, but why doesn't it matter? I'm not interested if those moving averages cross each other. If I'm looking for crossovers of moving averages, or if I'm looking for a cross of price and those moving averages, I feel that those are lagging indicators and those give me signals in hindsight. I'm late to the party. That famous golden cross, the 50-period moving average, is crossing above the 200-period moving average. Yes, it shows me the trend is up, but it has been up for quite some time. And usually everybody is already long that market. Same is true once the 50 starts to drop below the 200. I'm late at that point because, yeah, let's just quickly go back here and have a look at the ES 500, at the ES. Sorry, guys. Now, guess what? The 50 is still trading way above the 200. Don't you agree that it would have been very nice to sell this market up here? But if you will have to wait until the 50 now starts to drop below the 200, price might be somewhere back in 1,000 something territory. We are way late to the party with that. And therefore, using moving averages like that, those are lagging indicators. What moving averages are great to be used for, however, is they help me to understand what the current trend is. US oil market has been going sideways here, and guess what? Those moving averages here are pretty much all over the place. I can't really tell you if the 10 is above the 20 or the other way around. The 50 is also very close, the 200 as well. Those are so close together here. It doesn't make any difference here. It doesn't mean something. Typical for a range-bound market. But once price starts to move, you can see they start to fan. That's what we like to call our fanning pattern. The 10 is now clearly above the 20, clearly above the 50, and also clearly above the 200. And this is what we want to use them for. We can see this is an uptrend, higher highs and higher lows, and I don't have to check price action. It's sufficient for me to just have a look at my moving averages to see that. The next thing is moving averages are also great to see if price is overextended. Once again, let's go back to the S&P 500 and let's get rid of that fib retracement here and the other one. And price was not really overextended here at that point in time, but guess what? Once we move to a weekly chart, we have moved away quite a bit from my moving average buy zone here. And even worse, if we move to a monthly chart now, price was very far away from those price equilibrium levels. The 10 and 20 period moving average, the buy, the sell zone, they help me to identify those areas where price is resting, where it's not overly stressed, overextended, extended, it's just sitting there. And you see price was very far away, and this huge drop in the market where everybody said the sky is falling, guess what? It just very briefly fixed this overextension that we got here on the monthly chart. So if everybody tells you we are doomed, no, we're just fixing overextension here on the monthly. It's still a beautiful uptrend here on the monthly chart. It's still, the weekly chart is also tough call on the weekly. That drop here to the 50 period moving average on the weekly, that's something to stomach, but on the monthly chart, it's just still about fixing overextension. Price is mean reverting. It pushes away, it moves away from the moving averages and it pulls back to them. And we like to use moving averages for that. And if you switch now between a simple moving average and an exponential moving average, you will realize that just the location of those moving averages shifts ever so slightly, but they will probably always give you that same story. For that reason, you pick what you like best, experiment with both, but then stick with them. That being said, now finally, really, let's talk about oil. Beautiful uptrend, higher highs and higher lows. Guess what? We have made a lower high just recently, and we also made a lower low. Those moving averages are still in an uptrend, but those highs are also showing divergence here, 2-3 leg divergence here in our MACD and in RSI, which means price made a higher high, but this higher high was not confirmed here in MACD. When price made a higher high, MACD made a lower high. RSI also made a lower high. So at that point in time here, this was an early warning sign that something might not be quite right, and that this probably is a buying opportunity that we should pass because something doesn't look quite right. Picture the rocket is standing on the launch pad. Everything looks beautiful. You see the smoke, you see the fire, but the early warning sign is you see on your sensors and indicators that the pressure in the fuel chamber is not high enough. The rocket engines will not have enough power to lift that rocket off the launch pad. And this is what we're seeing here. Pressure is falling. Buying pressure is falling. Buying pressure is not in line with those higher prices that we see. There might be trouble ahead. And pretty much after that, lower high and lower low. So crude oil currently showing some weakness as well. Obviously not as pronounced, but definitely not something I'm looking. I'm not looking for any buying opportunities here. Let's talk about gold. Gold, unfortunately, gives us pretty much that same picture here. Beautiful uptrend, higher highs, higher lows, lower high, lower low. So currently, I also see more selling pressure here. The daily chart doesn't give me any opportunities. Maybe the lower time frames will do. Currently, the hourly, for example, here also just shows me a range-bound and sideways market. Let's close it off with silver. And silver, I also want to start here on the daily chart and just compare that with what we had with gold. Gold was in a clear, beautiful uptrend on the daily chart. Here on the daily chart for silver, however, that trend was not so clear. You can see that price made higher highs, but those lows were also lower lows. Actually, we started to see some kind of volatility expansion. Candles getting larger, higher highs, higher lows. Moving averages never looking so close and so strong. And guess what? We saw this level. That level had been established back here in the day. The market reacted to this level once again, broke above it, acting a little bit as support, now coming back to act as resistance, and we're back in this range here between 17.24 and around about 16.42. If I want to be bullish, some precious metal, it would be definitely gold compared to silver, but that bullish vibe definitely is also coming with a huge shadow and not being really supported here. People always think gold and silver, they move. It doesn't matter which one you trade, because they move just due to the high correlation in the same way. I hope you can see here that this is just not the case. If you think one sector is performing in a certain way, it always makes sense to analyze and have a look at all the elements within that sector, because obviously price reaction can be quite different. All right, guys, that's it from silver. Let us quickly jump back here to the final slide. That's been it pretty much from me for today, for today's webinar. If you have any questions, please again, just let me know and I'll try to answer those questions. I hope you enjoyed today's session, you found it useful. Stay tuned for next week. Next week, we want to have a better look and understand how binaries actually work. What are the mechanics within binaries and how can we trade them and apply them to the strategies that we're using. And yeah, just as always, if you have any feedback for us, please let us know. And now, as we don't seem to have any questions, thank you very much for tuning in once again. Now to all of you, have a great day, happy trading. Thanks again, take care and bye-bye.